Picture this. You're driving your newborn home from the hospital, right? In the backseat is, the absolute love of your life.
Yeah, and mathematically speaking, you also just strapped a $500,000 two-decade liability into a car seat.
Right. It is completely terrifying. But today, we are entirely removing the financial panic from that equation.
We really are.
Welcome to this deep dive. Our mission today is to cut through that overwhelming, sleep-deprived anxiety of new parenthood. We're handing you a really clear, actionable roadmap for securing a foundational life insurance policy.
And we're pulling all our insights today from an incredibly comprehensive source. It's the Life Insurance for New Parents Complete Guide for 2026, published by Life Insurance.
Yeah, and it's a lifesaver. Because, okay, let's unpack this. Calling a baby a financial liability sounds incredibly harsh.
It does. It feels a bit cold.
Right. You love them, they are your whole world. But if we are looking at a household balance sheet, they represent a massive, unavoidable future output of cash.
Yeah, that's just the pragmatic reality. I
Mhm.
mean, if we look at the baseline numbers from our source material, according to USDA research, just raising a child to the age of 18 costs around $310,000 in today's dollars.
And I'm guessing that terrifying number doesn't even factor in, like, college tuition.
Oh, it absolutely does not. If you add a 4-year university education into the mix, that total can easily surge to $500,000 or even $600,000 per child.
Wow.
So yeah, you have a baby, and you have instantly created a $500,000 future obligation. Our source frames this with a stark reality check that I think every new parent really needs to internalize.
What's that?
They say the day you bring a baby home from the hospital, you can no longer afford to be uninsured.
Right. Because before kids, if a couple is both working and, God forbid, one partner passes away, it is an emotionally devastating tragedy.
Obviously, yeah.
But financially, the surviving partner can usually figure it out. Like, they can downsize, they can adjust, but a newborn cannot earn an income.
No, they depend on you entirely for, well, everything. Food, shelter, healthcare, education for the next 2 decades.
Exactly. And if that entire $600,000 burden falls squarely on a surviving partner who is simultaneously navigating, profound grief and just the sheer exhaustion of solo parenting.
That is a preventable catastrophe.
Right.
Which is exactly why we have to shift our mindset here. This isn't an eventually task. The stakes are immediate.
But staring down a $600,000 liability per child usually induces sheer panic.
Oh, absolutely. And when people panic, they just guess.
Yeah, I see this all the time. People know they need coverage, so they log into their company's HR portal, see an option to check a box for maybe $250,000 in group life insurance, and they think, great, $250,000, I'm covered.
Yeah, it feels like a big number.
But how do we move away from that blind guessing and actually calculate the real protection a family needs?
Well, what the data actually points to is getting away from guessing entirely. There's a concrete mathematical framework designed for this exact purpose. It's called the DIME method, D-I-M-E. It stands for debt, income replacement, mortgage, and education.
Okay, let's break that down, because I really want to understand the underlying mechanics of why that default $250,000 HR policy is almost always a massive shortfall.
Right.
So the D is debt. I assume this means things like credit cards and student loans.
Yes. The goal here is to clear any outstanding personal debts, so your surviving family isn't inheriting a negative balance.
Makes sense.
So if you have, say, $40,000 in private student loans and car payments, that gets added to the total. Then we move to the I, which is income replacement.
Okay.
And this is where people drastically underestimate. You aren't just replacing 1 or 2 years of your salary. The standard recommendation is to multiply your current annual income by 10 to 15 years.
Wait, 10 to 15 years?
Yes.
So if someone is earning $75,000 a year, they need at least $750,000 just for the income replacement portion of this formula. That seems huge.
It does seem huge, until you look at the why behind it. The goal isn't just replacing a paycheck. It's buying the surviving spouse time and choices.
Okay, I see.
You are accounting for inflation over a decade. You're ensuring that a grieving solo parent isn't forced to take on extra shifts or, abandon their child to work 2 jobs just to keep the lights on. It provides a massive runway of stability.
Wow. Okay, yeah, that makes total sense.
And if it's a 2-income household, you must calculate both incomes independently.
So you don't just insure the higher earner. Got it. Okay, moving to the M mortgage. This feels straightforward.
Yeah, very straightforward.
You want enough capital to completely pay off the remaining balance of your home loan.
Right.
Because if a spouse passes away, the absolute last thing the surviving parent and child should face is losing their family home, right?
Exactly. You don't want them choosing between the mortgage payment and groceries. You erase the housing debt entirely.
Okay. And finally, the E stands for education.
Right. Our source recommends setting aside $100,000 to $250,000 per child for future college costs, depending on whether you're aiming for public, private, or professional schools.
So what does this all mean when we look at the actual gaps? If people are carefully calculating their debt, their 10 years of income, their mortgage, their kids' college,
What's the blind spot?
yeah, what is the biggest blind spot? What is the liability that isn't intuitively obvious on that dime list but completely sneaks up on families?
The most dangerous blind spot is childcare, specifically regarding the stay-at-home parent.
Oh, interesting.
Yeah. What's fascinating here is that society often fails to put a dollar amount on unpaid domestic labor, but the life insurance industry absolutely must.
Because they have to quantify the risk.
Exactly. Think about the mechanics of it. If a stay-at-home parent passes away, the surviving working parent cannot just quit their job to watch the child.
Right.
They suddenly have to hire full-time childcare, a house manager, essentially replacing all that unpaid labor.
And that is staggeringly expensive. You're talking about daycare, nannies, after-school care.
It is. In today's market, that replacement cost is roughly $40,000 to $80,000 a year, depending on where you live.
Oh my God.
Yeah. Over the course of a decade, that easily adds $500,000 to $800,000 to your required coverage total.
That is insane.
A stay-at-home parent represents hundreds of thousands of dollars in annual economic value to a household. Leaving them uninsured is a catastrophic oversight.
Okay, let's look at the specific example provided in our source material because seeing the actual math is a total light bulb moment.
Let's do it.
Let's say we have a household with an $80,000 income, a $350,000 mortgage, and one child. According to the DIME method, replacing that income for 12 years requires $960,000.
Right.
Add the $350,000 mortgage payoff. Add $500,000 to replace the stay-at-home child care labor over a decade. Add $150,000 for the child's future education. That totals roughly $1.96 million.
That is the math. Yeah, for most new parents in their late 20s to mid-30s, the actual target they need to hit to be fully secure is somewhere between $1 million and $2.5 million in total coverage.
And this is where the anxiety spikes again. Because as a new parent, your budget is stretched to the absolute limit.
Oh, completely.
You're buying diapers, you're buying formula, you're looking at pediatric bills. Hearing that you now need a $2 million insurance policy sounds completely financially impossible.
It sounds like a joke.
Right. How on earth does a young family afford that much coverage?
Well, this is where we bridge that massive coverage requirement with a very tight budget. And we do it through strategic product selection.
Okay.
The answer for almost all new parents is term life insurance.
I always try to explain the difference between term life and whole life using real estate.
Oh, I like that comparison.
Yeah, like term life is like renting an apartment and whole life is like buying a house. With term, you are just renting a massive umbrella of protection for a specific period of time, the term. It doesn't build equity, it doesn't have a savings account attached to it, you just get pure protection. Whole life is buying the umbrella forever, and the insurance company uses the handle of the umbrella as an investment vehicle to build cash value over your entire life.
That is an excellent analogy. And because you are only, renting that protection with term life, you're only paying for the sheer mortality risk during your healthiest years.
Which keeps it cheap.
Exactly. You are stripped of all those expensive investment management fees associated with whole life. You don't need a multi-million-dollar policy forever. You only need it for the specific window of time when your child is financially dependent on you.
Okay, here's where it gets really interesting, because the math on this is extraordinarily compelling.
It really is.
Our source points out that a healthy 30-year-old non-smoker can often secure $1 million in 20-year term coverage for just $30 to $50 a month.
Yep.
That is literally less than most people spend on their monthly streaming service subscriptions.
It completely reframes the conversation, doesn't it? Price is simply not a valid excuse to leave a newborn unprotected, when you can leverage your youth and your health to buy a massive amount of protection for pennies on the dollar.
But let me push back for a second.
Sure.
Because new parents are constantly targeted by financial salespeople pushing whole life insurance, especially policies you can buy directly for the baby.
Oh, yes. The Gerber baby policies.
Right. You see these ads everywhere. Buy a policy for your child today to lock in their insurability for the rest of their life. Isn't that something we should be doing?
It is a product that exists, but our source has a very strict hierarchy regarding this. You must secure maximum term coverage for the parents first.
Period.
Period. Whole life insurance for a child is a secondary luxury planning tool.
Hmm?
Yes, it's a nice way to lock in their future insurability, regardless of health changes later in life. But it is a mathematical trap to buy that if the parents themselves are underinsured. Think about it. If the parents aren't around to pay the mortgage, the kid's whole life policy doesn't do them much good in the immediate aftermath.
Yeah, that's a really good point.
The absolute priority is protecting the child's current standard of living.
That makes total sense. Secure the foundation first. So if we are going with term life, the source talks about choosing between a 20-year term and a 30-year term. How do I know which one to pick?
It's all about matching the policy to the horizon of your financial liabilities. A 20-year term is ideal if your primary goal is to get your newborn safely through high school and into college.
Because by the time the policy expires, they'll be 18 to 21 years old.
Right, exactly.
But a 30-year term is often recommended for younger parents, right?
Yes. A 30-year term fully aligns with a standard 30-year mortgage. It sees your child not just through college, but well into their own career and independent adult life.
Oh, I see.
It provides maximum certainty through your peak earning years. And crucially, a 30-year term avoids the need for you to try and undergo underwriting for a new policy in your 50s.
And just to clarify for everyone listening, underwriting is simply the insurance company's process of assessing your health risk.
Yes.
They look at your medical records, your family history to determine how risky you are to insure. Doing that in your 30s is a breeze.
Usually.
Trying to pass that health assessment in your mid-50s when you might have developed like high blood pressure or other conditions can be incredibly expensive or even result in a denial.
Exactly. Lock in the long term while your health is pristine.
Okay, so you run the dime math, you realize you need $2 million, you realize you can easily afford it with a 30-year term policy for $50 a month. You buy it, you're fully protected, right? You can sleep easy.
Not exactly.
And here is the trap.
Having the right amount of coverage is completely useless if the money doesn't legally reach your child.
Wait, what?
Yeah. There is a massive administrative and legal minefield waiting at the finish line, and it is entirely centered around how you designate your beneficiaries.
Right, because common sense tells me, okay, I bought this specific policy to protect my newborn baby. Therefore, I should just write my newborn baby's name on the dotted line that says beneficiary.
That's what most people think.
But the source explicitly warns against this. Why?
Because of how the legal system views minors. A minor cannot legally sign a binding contract, and therefore they cannot legally own or manage large assets.
Oh.
Life insurance companies cannot legally cut $1 million check to a 3-year-old.
So what actually happens? If a parent passes away and the baby is named as the beneficiary, where does the money physically go?
It gets trapped in the legal system. The life insurance company holds the funds, and the probate court has to step in to prevent fraud.
You're kidding.
I wish I was. A judge must officially appoint a guardian of the estate to manage those funds on behalf of the child. It is an expensive, highly bureaucratic, and deeply time-consuming process. We are talking about months, sometimes years, of legal wrangling.
That is horrifying. You bought this policy specifically to avoid financial stress for your grieving family, and instead you have accidentally bought them a lawsuit with probate court.
Essentially, yes.
The surviving parent might literally have to ask a judge for permission to use the insurance money to buy groceries or pay the mortgage.
It happens all the time.
So what is the actual mechanism to structure this correctly?
The safest standard structure outlined for new parents is this. You name your spouse as the primary beneficiary. If you pass away, the money goes directly and immediately to them, bypassing the courts entirely.
Okay.
Then you need a contingent beneficiary, which is just the legal term for your backup plan in case both you and your spouse pass away simultaneously.
And who is the backup?
You name a children's trust or an adult custodian under your state's UTMA laws. UTMA stands for Uniform Transfers to Minors Act, which basically designates a specific trusted adult to handle the money for the child until they come of age.
Okay.
But if your death benefit is over $500,000, which, using the dime method, it almost certainly is, a properly structured life insurance trust is highly recommended.
I like to think of a trust as a locked, bulletproof vault. The trusted guardian you select has the key to the vault. But the trust document itself is a legal map dictating exactly how they are allowed to spend the gold inside.
I love that visual.
It ensures they can only use the funds for the child's education, healthcare, and well-being, providing absolute professional oversight.
That is a perfect way to conceptualize it. And speaking of legal maps, this brings up another massive legal trap mentioned in the guide, the supersede rule.
Oh, this part blew my mind. I am still dramatically indignant about this.
It is vital to understand. Beneficiary designations on a life insurance policy supersede your will.
What?
Let me say that again. They legally override whatever is written in your last will and testament.
Wait, you are telling me that if I go to an attorney tomorrow and I draft a legally binding notarized will that clearly states everything I own goes to my spouse and my newborn child?
Yes.
But 10 years ago, when I was single, I got a small life insurance policy through work and mindlessly named my parents or an ex-partner as the beneficiary.
If you pass away, the life insurance company will write the check to whoever is listed on that old policy, period.
That is insane.
Contract law governs life insurance, not probate law. The contract you signed with the insurance company 10 years ago does not care what your newly minted will says.
Wow.
This is why you must rigorously review and update your beneficiary designations after every single major life event.
That is wild. It just goes to show how checking a box in an HR portal a decade ago can completely derail your family's future.
It really can.
Okay, we have covered a massive amount of ground. We have the underlying math with the DIME method. We have the product solution with term life. We have the legal mechanisms with the trusts and the superseder rule.
We've hit all the big ones.
Let's ditch the sterile checklists. Let's imagine what this actually looks like for a real couple in the real world. Let's say it's a Tuesday night, the baby is finally asleep, and these new parents sit down at their kitchen table to get this done. What is the chronological action plan?
I love that framing. Okay, here is your Tuesday night battle plan. First, they open a laptop and run the die math. They add up their debts, multiply their incomes by 10, add the mortgage, and add future education and childcare costs.
So no guessing.
No guessing. They arrive at a specific target, likely between $1 million and $2.5 million.
Perfect. Math done. What's next?
Second, they get quotes for both partners simultaneously. They do not say, we'll insure the primary earner today and figure out the stay-at-home parent later.
Right.
They quote both right then because, as we established, replacing unpaid domestic labor is an $800,000 problem.
Got it.
Third, they look at those quotes and choose a term length. They look at their mortgage payoff date and when their child will turn 22, and they likely select a 30-year term to cover that entire window of vulnerability.
Fourth step is actually applying. And the source notes a huge relief here for exhausted parents. Many term policies under $2 million no longer require a grueling in-person physical exam.
Oh, that's a game changer.
Yeah. You often don't have to schedule a nurse to come to your house and draw your blood while your baby is screaming in the next room. The underwriting is increasingly algorithm-based and can be completed entirely online.
Exactly. The barrier to entry has never been lower.
So what's step 5?
Fifth, as they fill out that application, they set up the beneficiaries correctly. They name each other as the primary beneficiary, and they list their newly established trust or UTMA custodian as the contingent, the backup.
And they do not write the baby's name on the form.
They do not write the baby's name on the form. And finally, step 6, they set a recurring calendar reminder for once a year to review it all.
Right, because life changes.
Exactly. Their financial life will evolve. They might have a second child. They might buy a bigger house. Their coverage needs to adapt alongside their life.
When you lay it out chronologically like that, it transforms from this overwhelming, free-floating anxiety into something incredibly empowering.
It really does.
You are taking back control, you are securing total locked-in peace of mind for your family, and you're doing it for less than the cost of a couple of streaming services.
Yeah, it's pretty incredible when you put it like that.
To summarize the absolute core takeaway from our deep dive today, life insurance is not an eventually task. It is not something you put on the back burner until the kid is walking or heading off to kindergarten.
No.
It is the absolute foundational safety net required from day one of your child's life.
If we connect this to the bigger picture, it really highlights the necessity of critical thinking in personal finance. Don't just accept the defaults. Don't just check a box because it's easy.
Right.
Use the DIME method to actually understand why you are buying the coverage.
Right.
Understand the specific liabilities it is meant to erase, and ensure you have the proper legal mechanisms in place so that the money actually reaches and protects the people you love most.
And speaking of those legal mechanisms, I want to leave you with a final provocative thought to mull over today. We spent a lot of time discussing the superseded rule, how a life insurance beneficiary designation completely overrides your will.
Yeah, that's a big one.
Well, life insurance is not the only financial product that operates under contract law instead of probate law.
Oh, true.
Think about your 401k. Think about your IRA. Think about that random savings account you opened at a local credit union back when you were 22. What other financial accounts out there currently have an outdated beneficiary listed?
That is a terrifying thought.
Right. Is there an old form sitting in a server somewhere just silently waiting to bypass your family and completely derail your estate planning? It might be time to grab a cup of coffee this weekend and do a full, ruthless audit of every account attached to your name.
I highly recommend that.
Because bringing a new life into the world is, mathematically speaking, like adopting a massive financial liability. But as we've learned today, with the right calculations and a bit of foresight, you have the exact tools you need to manage it perfectly.
You really do.
Thank you for joining us on this deep dive into securing your family's future. Go hug your kids, check those beneficiary designations, and we will catch you next time.